Investing your money gives you three different types of benefits. Number one, it helps you build wealth. Number two, it gives you financial protection. And number three, it can help you take advantage of tax laws and tax strategies. As an attorney who's not your attorney, what I can tell you is that our economic system, our tax code is designed to benefit investors. It is not designed to benefit employees. I'll show you. Let me start by breaking down the tax side because I think this is one of the most interesting, one of the most overlooked, and one of the easiest to understand. Our tax code, our IRS tax code, taxes income differently depending on how you earn it. How do I know this? Because I am a licensed attorney. Obviously, I don't work as an attorney, but I spent a lot of time studying the tax laws. And you have three general buckets of income according to the IRS. You have earned income. This is also known as ordinary income. You have portfolio income, and then you have passive income. Portfolio and passive income are two different types of investment income. So if you go out and you invest your money into the stock market, you own a stock for 5 years and it doubles in value and you sell it, that is portfolio income. If you own a rental property and it's paying you income every month, that's considered passive income. The rental income is considered passive income. These two types of income, your portfolio and your passive income, are investment income. And the reason why you want to understand this is because your investment income comes with either A, lower tax rates, or B, higher tax write-offs compared to your ordinary income or your earned income, which is your W-2 income, the money you make from your job. When you make money from your job, you're paying the highest tax rates and you're getting the lowest tax write-offs. So if you are a high income earner, you're making hundreds of thousands of dollars a year, maybe you're a doctor, you're an attorney, you might be paying about half of that money in taxes because you got your state taxes, you got your FICA taxes, then you got the federal income taxes you got to pay. Well, if you make that same amount of money from your portfolio income or your passive income, you're going to be paying a whole lot less. You could be paying 20% of your income in taxes. That's the top tax rate on portfolio income today. Because if you made $1 million from your long-term stock market investments that you sold, well, the top tax rate today is 20%. When you earn that money from your job, it's a whole lot higher. We're talking about double that here. So top tax rate to 20% here. But if you make this money from real estate, now it's a little bit different because you qualify for a whole lot higher tax write-offs. Because as a real estate investor, one of the things that you can do is you could tell the IRS, hey, I made $1 million from my real estate investments, but I qualify for a tax break because my property is 1 year older. Yeah, I know my property went up in value by $200,000, but I still deserve a tax write-off. It's 100% legal, and this is why you see so many real estate investors bragging about how they can make millions of dollars and pay little to no money in taxes legally. Our economic system and our tax code is designed to benefit investors, not W-2 earners. This is one of the things they should have taught in school before you graduated, but unfortunately they didn't. But this is why it is important for you to become an investor, because you can take advantage of what's happening on the tax side of things. Now, let's move up to protection. Many people know me from Minority Mindset, my podcast, this YouTube channel where I talk about all things financial education. But the funny thing about this is Minority Mindset is my hobby. My full-time job is I run a company called Briefs Media. I'm the CEO of Briefs Media. Now, the risk with that is I run this company and businesses go bankrupt. If my business were to go bankrupt, my income goes to zero, I stop making money. That's the problem. But here's the protection that I have. I also own investments. I have a real estate investment portfolio. I have a stock market portfolio that pays me with dividends every 3 months, every quarter. And so now, if Briefs Media were to go bankrupt, I'm not going to starve tomorrow. And the reason why is because I'm still making rental income every single month from my investments. I'm still making dividend income every 3 months from my stock market portfolio. So I have a layer of protection because now I'm not solely reliant on one income. Now, I want to say this with a little bit of caution because there's a lot of people on the internet that talk about how millionaires have 7 streams of income and 10 streams of income. You have to have multiple streams of income. And then what people think that they should do is, I need to go out and create 7 streams of income. So now you start to do as many things as possible. You try to start an e-commerce store, you try to day trade stocks, you try to flip real estate and do all these things, and you're going to end up going nowhere with everything. The reason why millionaires and successful people can have multiple streams of income is because they built one successful stream of income first, and once they built this, once they made $1 million from this one thing, they could then diversify into a second, and then diversify into a third. See, it's easier to diversify once you build one thing, and that's kind of the way you need to think. So if you're working now in your job, and you're working to grow your income here because this is your active, this is where your time is, to grow your career, to grow your skills here, that's good. Nothing wrong with working a job. I don't understand what people on the internet try to say, oh, you should not be an employee. Look, if you like what you do, great. If you hate what you do, look for something else. Okay, I want you to love what you do. You don't have to start a business. Starting a business is not for everybody. I just want you to enjoy what you do. So if you're working a job, great. Continue to work to increase your income there. But then you want to work to create a second stream of income, which is something you can do without working very hard to do. And I say this with caution because I don't want people to get caught up into this idea of I'm going to go out and build this online business that doesn't require any work. Because when people talk about how you can make $10,000 a month without doing anything on the internet, they're generally selling you a scam. So what I want you to understand is when we talk about this type of protection now, it's investing your money into proven assets, real estate, stocks, things that have been around for a long time that have built a lot of wealth. I mean, real estate and stocks are two of the asset classes that have built more wealth than anything else over the last 100 years. And so if you can now funnel this money into these assets, you now can create a second income stream that you don't have to work to earn, and this can continue to pay you even if something happened to your ordinary income, to your job or your business. That's why you need to be investing your money. Now, when it comes to your wealth, what I want you to understand when you invest your money is you have two general strategies of investing. You have what I call an active strategy, and then you have a passive strategy. Passive investing is a set it and invest it strategy. Active investing is where you're looking for individual investments. I'm not talking about stock trading. I'm not talking about real estate flipping. I'm talking about looking for an individual company, an individual piece of real estate that you are going to own and manage yourself for the long term. Passive is you're investing into somebody else's real estate fund. Hey, I'm a real estate investor. I'm looking to raise $5 million to invest in this apartment complex. Do you want to invest $10,000 into me and then I do all the work? That's passive investing. Passive investing is you going out into the stock market and you're investing into an index fund or an ETF or a mutual fund that's managed by somebody else, and now you just keep giving them money every week or every 2 weeks or every month, and you don't have to worry about it because you have this manager that is managing the fund. And now you have this diversification because you're investing into a whole broad list of companies, and it's a set it and forget it strategy. You just keep investing every week, every 2 weeks, or every month. This is where you have to think about what type of investor you want to be. And you don't have to pick one. I do both. I have a passive investing strategy where my money is invested into my portfolio of ETFs. This happens every Wednesday, whether the market is up, whether the market's down, it does not matter. Now, I got to give you a disclaimer because investing has risks. You are never guaranteed to make money when you invest. In fact, you will lose money when you invest, which is why you need to do your own due diligence and never blindly trust a random guy on YouTube. I don't recommend what I do to anybody else. I'm just telling you what I do as an example. I invest passively every Wednesday, no matter what's happening in the markets, because I want to grow my exposure, and the bulk of my passive investments are for cash flow. They were dividend producing funds. Then I also have an active investing strategy, which is now I'm looking to invest my money into individual stocks. I'm looking to invest my money into individual real estate. So I have money going into bank accounts that are sitting there waiting to be invested. When I find a good real estate investment, when I find a good stock market investment, then I will take out that money and deploy it there, but it's not automatically happening. The money is automatically being saved, and I'm just waiting for a good investment. That's what active investing is. You gotta find what's right for you. Do you want to be more involved? Do you want to be less involved? Do you want to take on more risk because active investing has more risk than passive investing? Or do you want to take on less risk? Do you want more potential upside? Active investing has more potential upside than passive investing, but it comes with the more risk. And that's where now you gotta dig into your own financial education and understand what is the right investing strategy for you, because if you blindly copy what somebody else does, you're probably gonna lose. Which is why you have to invest in your own financial education. This is why investing your money is so important. You can take advantage of the tax laws, you get the financial protection, and you can build wealth. This is what wealthy people do. Wealthy people invest. They own real estate, they own stocks, they invest in businesses, because that's what allows them to keep their income, grow their income, and continue to fund their lifestyles. But you have to take the first step and start investing, because I get it. It's scary, it's risky. But in order to do that, you gotta systemize your money and not spend every dollar that you earn. Once you do that, then you can start investing. And I know this can be overwhelming. If you've never invested your money before, it's scary. If you've never opened a stock brokerage account before, it seems like there's so much work involved. But I want you to remember this. When you take a look at somebody trying to get healthy, trying to get fit, You can get into this rabbit hole of how do I exercise? Do I need to do high intensity exercise, resistant exercise? Should I do Pilates? Should I do yoga? What do I do? And what about my diet? Should I go keto? Should I go low carb? Should I go vegan? Should I go paleo? Should I go carnivore? What should I do on my diet? And it can get very, very, very overwhelming. But one of the best things that you can do is just get started. Get on a treadmill and put down the donuts and ho-hos, and that's how you start. And then you can start learning more and doing more. It's the same thing with your money. It can be very easy to get overwhelming about looking at ETFs and analyzing index funds and analyzing mutual funds and expense ratios and different yields and this and that. But just get started. Systemize your money and start investing your money, and then optimize after you get started. The reason why many people lose isn't because they picked the wrong fund, it's because they never got started. And so the key is just get started. If you enjoyed this clip and you want to continue your financial education journey, I have another video that I think you'll love. All you got to do is click that button right over there. And for those of you who want to stay up to date on the top finance and business news, you can join Market Briefs, my free financial newsletter, by clicking that button below. Thank you for watching, and I'll see you in the next one.